we started figuring, hey, how are people able to leave their jobs or reduce time in their jobs? And I'm like, well, we need these things kicking off monthly cash flow so we can cover our bills. How do we do that?
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. Today, I'm thrilled to host Whitney Elkins-Hutten from PassiveInvesting.com. Whitney has a very interesting journey. She started out in medical school and then public health, and then one thing led to another, and she started flipping homes. And now she has grown big. I mean, really big. She has done over 6,500 units in various syndications. She has invested in over $800 million worth of real estate. These are some crazy numbers here, and we'll get into the details. She's now the Director of Education for PassiveInvesting.com. Whitney, welcome to the show.
Yeah, thank you so much for having me on, Game.
Whitney, I mean, I don't even know where to begin. It's there's a lot of things that I'm definitely interested in, but why don't we start off with how you started your career? It sounds like you were in med school and public health. How did you go from that, which sounds like a very lucrative career, sounds like a great career, a dream career for many, and yet you ended up going from there to flipping houses? How did that go about?
Well, I would call it anything but lucrative. If anybody that's worked in public health before, but it started off many years ago. My mom was in the healthcare system. She was a microbiologist, and was always loved the sciences. I wanted to go to med school. That had been my dream all the way through until about halfway through college. And then I saw the movie Outbreak, and I wanted to be like Dustin Hoffman and Rene Russo. And I was like, that's what I wanted to do. Chase infectious disease outbreaks, which meant I needed to go to public health school after medical school. And towards the end of college, I realized as I'm going into medical school that I actually could skip medical school and just get a public health degree. And so I was like, well, I'm already, I'm gonna do, start with medical school, see how it goes. Yes, it was not for me. Left medical school, went into public health school, got my master's, MPH, got my, well on my path to getting my doctorate in epidemiology. And then I switched to nutrition. That's a story in and of itself. But I was, 9/11 happened right after I graduated with my master's. And so I was working in bioterrorism, learning I was training doctors within our region how to identify smallpox and anthrax cases, how to vaccinate against smallpox. I was doing all the education and facilitation and training for biological, radiological, and chemical events. As you can imagine, when you're sitting in all these FBI meetings and you're being exposed to so much information that the general public isn't, I was like, some days I just want to be a normal citizen. So about this time, I'd also bought a house, and I was, while I'm traveling, 80 plus hours a week, for my job at this point in time, I had this house. I, bought it in a relationship. The relationship fell apart. And
So this house was going to be your primary residence.
It was my primary residence, but it was in dire need of a rehab. And so I was like, well, the relationship's falling apart. I need to get out from under this house. So let me repair it and see if I can make a little bit of money. Lo and behold, 11 months later, I walked away with $52,000. And because I had, house hacked, had brought in roommates, I actually hadn't been paying for any of my bills at that point in time. So I was completely bitten by the real estate bug because I made more money in that 11 months with the house creating this value over here than I did with my job where I was trading my time for money. And so I actually saw the light bulb came on for me and was like, how many more of these can I do? Fast forward, I did several more flips. I did some of my husband, but we couldn't figure out how to create cash flow. And when we finally dawned on us, a friend of ours was like, well, why don't you just put a runner in your flips? I'm like, oh, that's genius. That's what people have been doing for hundreds of years, putting renters in their flips. And so it did that and started creating some stabilized cash flow that way. And we had probably like 10 properties at that point in time. And then I got laid off from my public health job. And, I was really kind of at a crux. We wanted to continue and scale our portfolio, but at the same time, I had this opportunity to reap some of the benefits of the cash flow that we were bringing in and work more part-time, be at home with our daughter. I was having to take care of family members at that point in time. And so we made some pretty interesting financial moves during that time. One, we were talking before the show, I broke up with the IRS during that year. I also, made the complete transition to BRRRR investing. So it's flipping houses, but I was flipping them to myself in order to pull my equity back out of there. And then I wanted to figure out how I could utilize our core portfolio to become kind of like a little mini ATM and scale our portfolio into larger institutional grade assets. So we were at this point in time trying to figure out how do we buy a larger multifamily for ourselves and or invest in somebody else's deal. And so we couldn't decide which one, so we did both. And anyways, several years later, where I'm at today, I'm the director of investor education at passiveinvesting.com. We have that personal portfolio for ourselves, but those are just numbers. Really what it allows us to do is to have 100% control and choice on how we spend our time and what kind of impact we're going to create in the world.
Yeah. So Whitney, let's quickly go back to the time when you hadn't been laid off yet, right? You got your full-time job. You're starting to fix and flip houses, and you've gotten bitten by the real estate bug, and you're making some good money there. I guess maybe walk us through how did you manage the cash flow? Because it sounds like that is always how should I put it? That's always a decision point for real estate investors, right? Do I want more equity or do I want more cash flow? How did you navigate that?
Well, so initially when I was doing live and flipping and house hacking, that strategy, all these strategies I kind of fell into. And so with not as much education as I probably should have had. And anyways, but so I was doing this live and flipping and house hacking. We were doing, I was taking advantage of the 121 exclusion, which is kind of like a 1031 exchange, but for, primary homeowners. And so every 2 years I was trading up property. Or, maybe sometimes I would exit at a year and a half and pay just a smidge of the tax bill because it is a sliding scale there. So we were building up this buckets of equity, but we didn't really have the financial knowledge to reinvest that in other cash flowing assets. We were just like, this is working for us. We're building up piles of money. So I didn't actually have that knowledge. I'm the person who read Rich Dad, Poor Dad and got it wrong.
What do you mean you got it wrong?
Well, because quite clearly in Rich Dad, Poor Dad, like when you go back and read it, because I read it in 2001 before I bought my first property. And then I read it again, I think about 2015. And I was like, he laid it out right here. Like, take your money and you go invest in assets, the cash flow. I totally didn't do that. I was just like, I saw real estate and I ran with it. But it was really, as we're kind of, and so we're talking about, 12 years here. So it wasn't an overnight decision. We started figuring, hey, how are people able to leave their jobs or reduce time in their jobs? And I'm like, well, we need these things kicking off monthly cash flow so we can cover our bills. How do we do that? And it seems like such a simple question, but I didn't have the knowledge to go find the answer. So at the same time, we're stocking away as much cash as we can in our company, for my company 401k, as well as my husband's TSP. And I was like, I don't know how to make this thing cash flow over here, because if we retire, that's what I thought where our cash flow was going to come from. So I read Money Master the Game by Tony Robbins. And then again, the curtain got pulled back on what, the Wall Street casino. And I was my benefits manager, worst nightmare for a couple of years. We were really close friends, but she was like, Whitney, we don't do that here. We don't invest in commodities. Whitney, we don't do that here. You don't understand. This is very, very simple investment structure. So I had to seek other forms of education, and I stumbled onto Bigger Pockets. And at that point in time, we had already had one rental under our belt. Mind you, we had put $80,000 down payment on the property. We completed a minor rehab on the property. We put the tenants in there. So I was like, check, check, check. We're doing what we need to be doing in order to get stabilized monthly income. And then I learned how to run the numbers. And this is kind of ironic because I have a stats background. But I didn't know what numbers I needed to calculate. And I ran the numbers. I'm like, I made $400 a month. Like, how am I going to retire off of that? How much cash do I need to accumulate to be able to exit my jobs? And so that was really the telltale sign, right? The question was like, how do you know which one you need? I think for one, it depends on where you are in your investing journey. The younger you are, maybe you have a higher and better use in your job, but the closer you get to retirement, you might want to start taking some chips off the table and getting some assets moved over to cash flow. For me, I finally landed on the strategy that I wanted both right now, and I would just take my cash flow and reinvest it. And the reason why I wanted both simultaneously, especially good quality, high quality cash flow, is because if I ever hit a situation, which I did, I hit it twice in a 2-month period where I needed to step away from work and take an extended leave, I could. And I could flip on that cash flow machine and it was going for me. It was already built. Okay. My husband broke his neck and then my mom passed away about 4 weeks later. So but it wasn't, and and even before that, I had been laid off a couple of years before that. So, multiple times through this journey, we had that cash flow coming in nice quality assets that were also appreciating pretty well too. So I'm getting kind of a double whammy. We're reinvesting cash flow as quickly as we can back into the business to scale and get more cash flowing assets. But when you hit those challenges, it was super easy for us to be like, you know what, pause. Sure, we had our emergency savings accounts, but we didn't have to dip into them because we had that cash flow coming in.
And Whitney, can you give us a little bit more info on the timeline, right? Like how quickly were you accumulating properties and how long did it take you to figure out the game?
Well, so we fixed and flipped, and we actually still do a little bit of house hacking, fix and flipping. We were doing about 10 projects a year. Now we're doing like one project every like 3 or 4 years. So we're not doing a whole lot of flipping these days. But so we transitioned into buy and hold real estate in about 2015 into 2016. I think when I finally figured out my numbers, what we needed, what our goals were, like got really super clear, got that powerful clarity about that. That was 2016. And then that first year of buying rentals. And so we had just bought rentals in Colorado up until that time. And then we liquidated everything, moved it out of state. And that was 2017. We did 10 rentals. Our first year, we had 20 in the first 18 months. And we were at 30 at the end of 2 years and 3 months.
Amazing. And I hear that story quite often, right? The exponential growth. Somebody starts with one property and then two, and the next thing you know, they got 4, 10, 20, and it just kind of takes off.
Even our first deal out of state, it was interesting. I'm like, I'm going to do one and I'm going to just run it for 6 months and figure out, figure this whole game out, make sure I got my property management all lined up, that I understand like exactly what we're doing here and prove the model to myself. But I actually had 2 other properties under contract before I closed on the first one. I was just like, this is just too good to pass up. Now I can say these days the market shifted a little bit, right? It's a little bit, I think, a little bit more challenging to find those high cash flowing assets. But I still hear people all the time, especially in the multifamily world, where I hold a lot of my conversations, that they end up with 2 or 3 properties that they're looking at once. They might have a dry spell for like 6 months where they're working all their contacts, and all of a sudden they have like 2 or 3 of them come back at the same time. And they're like, well, how do I take them all down?
Yeah, totally. And why did you move out of state? I believe that right now you live in Colorado, and it sounds like you started your investing journey in Colorado. You're familiar with that market. What prompted the move out of state?
We wanted cash flow, right? So once we finally understood, Colorado during this time was amazing for flipping. I mean, it was an appreciation market. So we could continue to flip and harvest that large cash equity bump. But if I put a tenant in the property, that same property, I might have an $80,000 investment and it might only cash flow $400 a month, and that's with me managing the property and not setting anything aside for CapEx and maintenance. So my true cash flow probably was only like $50 a month. That's not good cash on cash at all. Whereas I could take that same $80,000, invest out of market, and get into like two, maybe 3 or 4 properties even out of market and get $400, $400 a month in cash flow. So $50 a month in cash flow with an $80,000 investment, or $1,000 to $1,400 a month in cash flow with an $80,000 investment, which is going to get you closer to your goals if your goal is to have that cash flow. And, that's where it was kind of a bit of a struggle, because so many people were like, oh, I'm just going to stay in Colorado because, the equity market. Well, equity, while it's trapped in the house, earns you 0% and it's 100% at risk at the market. And I was like, I'm not going to take that chance. Like, I need to get my foundation built. And then in the future, I can maybe take, some of those higher risk investments.
Yeah. And it's interesting that you mentioned that, because it is 2 different ways of looking at it, right? Whether you're investing for equity growth or cash flow. If you're lucky, you get both. But for example, if someone has a full-time job, a W-2 job, then they have cash coming in every month. So they can say, well, you know what, my cash flow security is from my W-2 job. My real estate investing is on the side. And so I don't need that much cash flow from real estate. But it sounds like when you didn't go back to your W-2 job, right, after you got laid off, then now you do need your investments to give you that cash flow every month. So now you have to find where you can get the best cash flow. Whitney, which states do you like right now? Where do you find the best cash flow deals right now?
Yeah, so I'm more in the multifamily space these days when it comes to residential investing. So the Carolinas, North, South Carolina, as a company, we have assets in Tennessee and Georgia. I think Texas still, parts of Texas are still very hot as well. But I would, kind of focus on that Smile area. Florida is good as well, a good market as well.
And Whitney, how did you get into your first multifamily deal? Was it your own deal? Was it syndication? How did you go from single families to like a large multifamily?
It was a very scary step for us. Again, you have these translatable skills, right? Now I knew how to analyze the deal. For single family, I had to kind of learn, apply those skills and learn how to put together a multifamily model. I had to redo our whole team, get a new realtor, get a new broker. But we initially went into partnership on a 52-unit building in Indianapolis and learned a ton because, a lot of us were pretty new to active investing with multifamily, and but did well with the property. But again, we got our education. We paid to get our education that way. Then I actually got into partnership with working with a private equity firm, and initially started off with handling the investor relations function, capital raising function, and then was part of the partnership for a couple of years. And we grew our active side of our multifamily portfolio that way. And at the same time, I'm still trying to take as many chips, like all of these streams of active income that we have coming in, from various businesses that we own, our own property, our own limited partner assets, and reinvest those into passive assets as quickly as I possibly could.
Whitney, what tips or what advice would you give somebody who is at that stage where they have several multifamilies and they're starting to grow their equity and their experience, and they're getting more confident and they want to move up to the multifamily space?
For 2 things. One, continue to invest in your own education. I mean, that's one of the best investments that you can make. And then 2, get into network with people, get into relationship with people, because with the, multifamily, you can take down a property by yourself, right? However, it's easier to take it down properties with groups of people, and, really, just work to try to find your tribe there. Because, especially if you're going to try to acquire multifamily people, properties, and then grow and scale maybe like either a holding company or a syndication company, you're going to need multiple people to help you round out that company.
Got it. So Whitney, it sounds like you had a lot of success in the single family rentals and fix and flips, and then you moved into multifamily, found success there. What interested you in car washes?
Yeah, so where I'm at, passiveinvesting.com, that is a vertical that we brought on last year. We actually, during COVID, we were working very hard to line up, get our ducks in a row to be able to launch this model. If you think about it, and maybe many of the listeners here would resonate with this, is you're trained. I know I was trained this way. Grow up, get a good education, get a job, go to school, invest in your 401k. And we're trained to invest in our 401k more than likely by chasing yield. What is going to yield the highest returns? Past having that stocks and bonds balance, whatever that might be, U.S. market, international market, get the ETF or the fund that's going to yield the highest, right? That's where most of us are trained. Well, a lot of people bring that experience into the passive investing world. And so that's what my job is to help them understand you need to switch your mindset and look at the operator, not the deal, but the operator, and understand who they are, because that's who you're investing with. Now, for us, we realize as the market shifted, as cap rate compression, is occurring in the multifamily space, cash flow is getting compressed, that we still have these investors that are fleeing the market wanting high quality cash flow. We want it for ourselves. And so we took, a very broad look at the market, and we're trying to scratch our heads to figure out, what part of the market is fractionalized right now that can, where we can jump in and start consolidating the market that still has a good amount of cash flow. And car washes was something that we, were watching for some time. Big money is not in the space right now, because there's no third-party management for these properties. So Blackstone doesn't want to pick up a whole portfolio of car washes because now they have to hire a regional operator. They got to manage property at this point in time. For us, we saw the opportunity to, one, invest in nice cash-flowing businesses that have low operational expenditures to them. And we're very specifically in the express car wash space. And we can go through the different types of car washes, but we're really specifically in this one niche part of car washes. So we can reap the benefits of cash flow there with this low operational expenditure business, high margin business. But the way we purchase our properties is we also own the land and we own the brand. So we're not doing this through franchise modeling. We are actually acquiring the portfolio, direct ownership of everything. And we own the third-party management company. So we really, it's a vertically integrated business. But, these businesses, once stabilized, kick off for the limited partner investor, 12 to 15% cash on cash a year. And we're positioning our investors to where they can get, a 60-40 split to 20% IRR, 40-60 to 30% IRR. And then we leave them uncapped past 30s where they're still participating in the deal alongside us.
Sorry, Whitney. Can you just tell us a little bit more about those numbers and those acronyms that you just threw out?
Yeah. Internal rate of return. So that is an IRR. So that's a great number for people who are getting into, any investment really, but specifically, into the private equity space. It's hard for investors to understand which assets that they're looking at, which deals they're looking at actually perform better, right? Because one asset might be a 2-year hold and, throw off like, say, a 10% IRR, which hopefully it would throw off more. Another one might be like a 10-year hold and it throws off like a 5% IRR. Then you might have a 5-year hold that throws off like a 17% IRR. And so how do you, what number of all these returns, looking at cash flow, annualized rate of return, equity multiple, IRR, which one allows you to compare apples to apples amongst all those deals? And it's going to be the internal rate of return number, because it takes into account time, whereas the other numbers don't take into account time. So that's the one number that you can compare across assets or all of those deals that you're looking at to figure out what you could potentially expect for a return. Now, I say that because a lot of people are like, I want a 17% IRR. And I'm like, when you're looking at a pro forma, it's the operator's best educated guess of how they think the business plan is going to go. So, it's one thing I can tell you, all performers are 100% wrong. So they're either going to be underperform or overperform. I have yet to see one that hits it directly on the mark.
Well, of course, yeah, no one's got a crystal ball, right? So Whitney, the other thing I heard about car washes is that you get really good tax write-down, like the depreciation I think it's an accelerated depreciation for gas stations and car washes. Tell us more about that.
Yeah. So, and I would imagine, so what I'm going to talk about is specifically for our car wash deals. I would imagine the same thing applies for gas stations. But when you purchase a car wash, especially in acquisition and not ground up development, we can actually write off everything. It's about 70 to 90% year one loss. We can write off almost everything but the land that first year, because the building is actually qualifies as a piece of equipment.
Got it.
Yeah.
And so your investors, right. And so on top of, it sounds like, so on top of the IRR on top of the return that your investors get, your investors also get to enjoy some of this tax depreciation.
Yep. So they get monthly cash flow. And so, we give them the first 10% of every deal, 10% preferred return. For years 3, 4, and 5, when we are projecting to go above that 10% cash on cash, they split in that as well. They get back end equity, for either when we IPO all the portfolio. We're looking to scale 250 to 300 locations in IPO. Our backup strategy is to exit to a REIT, which we're already in negotiations or planning stages with REITs to acquire the portfolio. And then the most conservative exit we show them is individual sale of the assets. And so they get that equity bump, however that looks like upon exit. And then they also get the tax benefit as well. So there's, I call it the 7 pillars of wealth, right? There's capital preservation, because we own the land, own the brand, own the vertical, the entire vertical. There's cash flow, there's equity, there's tax benefits. We can put lending on the property, so we can, smart use of lending, can also help amplify your returns. It's an inflation hedge as well. Like most real estate, we are able to lock in, a loan rate in today's terms and let inflation erode that loan. And then, the 7th pillar is investing with operators that have an amazing track record in the space. Now, for a lot of people, that 7th pillar, they're the operator, right? Like if they're doing their own single family, small multifamily deals, they're their own operator. But when you start learning how to invest in other people's deals, either to scale your portfolio, diversify your portfolio, or maybe you just I'm done owning property myself and I want to have somebody else do it, you have to learn how to vet the operator.
Amazing. So Whitney, how many years do your investors have to be in the deal? Like when is your planned exit?
Yeah, so we're looking to scale the portfolio over the first 3 years, stabilize it in year 4, 4 or 5, prep it for sale in year 5. So with this particular model, though, if it's a business that is kicking off, say, like 20% cash on cash a year, let's just say, we don't know, right? And it takes us an extra year or 2 to sell the portfolio. I can't imagine most investors being upset with having that, stabilized cash flow being kicked off. So we're really, looking to partner with people who understand that this is a business investment that owns land, and that, that it takes time to position a portfolio this size, about 5 to 5, 6, 7 years to either to IPO or do a large roll-up sale to a REIT.
Amazing. And I think you mentioned earlier that this is not a franchise. It sounds like you're developing your own brand of car washes.
Yep. Yeah.
Amazing.
We took a look at the franchise model, and there's no right or wrong way to do car washes, because, I run into people all the time that want to buy their own car washes, and they're looking at franchise models. For us and what we're trying to do and scale this large portfolio, and one IPO, we needed to stay away from that franchise opportunity. We needed to develop it ourselves, right? We needed to have that 100% control of the asset. 2, there's some things when you start getting into franchises, especially trying to scale with that, you generally get limited market share. So if you're entering a market and you yourself are going to have 3 or 4 different franchises in that market, fantastic, because you probably own the whole market share and can market to everybody in that market. But if you enter a market where somebody else already has a franchise of the same brand in that market, now you're kind of like drawing this line in the sand saying, these are my people, these are your people, and not only that, like maybe they don't run their franchise brand as well as you do. The customer really doesn't know that. They don't really care, so sometimes you can kind of, see some people not engage in the brand because one side of town runs theirs really well and the other side of the town doesn't, right? So we wanted to eliminate those risks for our investors, who can see the potential of doing this like large scale build out.
Makes sense. Yeah. Whitney, tell us a little bit more about passiveinvesting.com. What is the website about? What can people learn by visiting your website?
Yeah, so passiveinvesting.com, we're a private equity group, and our vision mission is in the name itself. We're a private equity group that aims to provide passive investments for our investors that are backed by hard real estate, that cash flow, provide equity, and that are invested in the highest and hottest growth markets in the United States. And so it's not necessarily real estate. To date, we have done real estate, but we look at all opportunities, in business and real estate.
Whitney, as I recall, you have a conference coming up in Charlotte, June 12th to 14th. Tell us a little bit more about what can people expect from that conference.
Yeah, the Multifamily Investor Nation Conference. It's Charlotte, June 12th through 14th. You guys should check it out. There we are going to have, we strive to make that kind of like an all-in-one place for people to, either kickstart their education in the multifamily investing space. This year, we have added in a ton of education on alternative assets. So you can go there and learn about multifamily, self-storage, car washes, hotels, short-term rentals, mid-term rentals, the whole like. But also, if you're, further along in your growth, it's a great place for you to meet operators if you're on the passive side of investment, or if you are an operator, meet, your potential passive investor.
Whitney, where can people reach out to you for more information?
Absolutely. So I have my own subpage on the passiveinvesting.com website, and it's passiveinvestingwithwhitney.com. And there I have some free goodies that you can't get anywhere else on our webpage. A free ebook to help people understand passive investing and make it simple for them to get into their first or next investment. I have a checklist, and also you can hop on my calendar and we can talk all things real estate.
I love it. Whitney, thank you very much for spending time with us today. I'll put all the links in the show notes that you mentioned. And it's a really cool story. So it roughly took about 20 years, right, to go from working in public health to running your own multifamily and car wash empire. I love it. Congratulations.
Thank you.
Have a wonderful day.
You too.